Hello, everybody, and today we have Peter Warren. He was he built the first database for Norwegian stock prices and started the options market in Norway and was the first hedge fund manager in Norway. So thank you so much for coming today, Peter.
My pleasure.
I'm going to kind of just jump to the most interesting thing here. What is a hedge fund?
Well, a hedge fund, if you think a mutual fund that has they have very strict rules in terms of what they can invest in and how much they have to invest at any given time. So if it's a Norwegian mutual fund, they will have to have 80 or 90% equities all the time. I mean, the manager can
stocks,
exactly. So the manager can think that the world is going to hell in a basket, but still he has to have 80 or 90% stocks in the portfolio, while a hedge fund manager does not have those constraints. So you don't have the constraints and you can use more instruments than just stocks or equities, as we call them, in your portfolio. So you can, let's say you believe that the oil price is going up. Well, a mutual fund manager will then have to buy oil companies, the shares in oil companies. A hedge fund manager can actually buy oil. You'll buy future contracts on oil. You can even store oil if you want. So if I believe gold is going somewhere, I could actually buy physical gold and have it stored in a vault usually is in Manhattan. I did that once.
Okay.
Well, I actually did that because I had a future contract and it went to delivery a day before I realized it had gone to delivery, so I actually owned physical gold.
Were you like the first Harry Potter movie when he opens the vault? Do you remember that? When he got all the gold from the parents? Is that how it looked?
I actually went over to because I was in New York and this was in a Bank America vault in New York, way under the ground in Manhattan, and I actually went there and they took me down and I saw the pallet that the gold and the number, because it didn't have my name or the fund's name on it. It had a number on it, and I had the ticket to that, and I actually saw the physical gold.
That's amazing. Yeah, but tell me a bit more about the hedge fund. What it means.
Well, the whole point, today there are people who, what is a hedge fund is quite difficult. A hedge fund can also use leverage, okay? So you can borrow money and increase risk, if you will, or increase its diversification. My opinion of a hedge fund is that either if the hedge fund, buys into stocks and is in a way dependent on the direction of the stock market, then for a hedge fund to justify its fees, a hedge fund should basically give you a better risk-adjusted return than a mutual fund. Okay? So that's the one type of hedge fund, and you have a number of hedge funds, particularly after 10 years of quantitative easing. You have a lot of hedge funds who basically are long the market with, own stocks and use leverage.
Quantitative easing.
That is when the central banks print money and use that money to buy bonds, and through that. They depress their interest rates, so interest rates go lower, bond prices go up. Have the inverse relationship. So basically what they've done, the quantitative easing basically has as a goal to make you as an investor risk your money, because you can have it in a bank account, and you say, okay, I earned, before all this started, maybe 5-6% per annum. So they lowered interest rates, so you got less and less. They pushed the yield on the bonds down by buying the bonds. So in the end, to get a return, you were forced to take more risk, i.e. you put your money into stocks, because that was the only other thing that pretty much the governments would let you do, unless you were very rich. And thereby inflating stock prices. Okay, so they're trying to get the economy going.
Okay.
So anyway, so you've got the hedge funds that basically play in the stock market and to a large extent are dependent on which way the stock market goes. So when the stock market goes up, they make money, and if the stock market goes down, they lose money, and you'll see that on the basis the results in October, where the stock market fell. You will see a lot of hedge funds losing money, too much money. But to justify the reason for being, they then should make a return, a better risk-adjusted return than if you just went and bought mutual funds. Okay, so that's the one. The second one, and I believe even more important reason for hedge funds, is to give investors an alternate revenue stream. So a revenue stream that does not come from stocks or bonds, okay, or systematically doesn't come from stocks or bonds.
Okay.
So if you've got another revenue stream, then basically you get what is called diversification. So you've got your stock and bond portfolio, and you've got another revenue stream coming in that is not dependent on the other two. Then you've actually got diversification. And diversification, to my knowledge, is the only free lunch within finance, where you actually are able to lower your risk and get a good return.
That's really interesting, because yesterday I had a class concerning corporate finance, and my teacher is really conveying that you wanna kind of increase your potential return, but still kind of decrease the correlation between those two things.
That is diversification. Exactly. That is diversification. You try to, you're hoping that the hedge fund you've invested in does not correlate with your other investments, i.e. stocks and bonds.
Yeah.
And that is really important for diversification, because if it has a high degree of correlation, you just added risk.
Yeah, and there's a concept, I don't know if you heard about diversification. It's a bit new, but diversification is the concept where you invest in the same type of sector where the correlations are very strong. You're just diversifying, you're not diversifying. Yeah. And but my takeaway from that is, then I want to invest in, like, let's say me and a group of people are analyzing Oslo Børs.
Yeah.
Ideally, we would go from sector to sector, pick out the 2-3 best companies in each sector, and that's a way of diversifying, because they're not that correlated. Maybe
you would diversify your stock portfolio, but you would not be diversifying your sensitivity to general market move.
Yeah.
So if the market falls out of bed, the chances are you still are harboring a lot of market risk.
Market risk are such things as like
whole stock market moving in one direction, like
a big macro,
big macro event, just the whole,
a risk that you can't avoid.
Well, you can avoid it through diversification, but you have to diversify away from, you can look at your portfolio of stocks, and people say, well, we want to go into safe stocks when it's when risk increases in the market. But the thing is, yes, you can do that, but you probably will still lose money. You might lose less because you've gone into safer stocks, companies with high earnings and stuff like that, or more bond-like. Yeah. But you will still lose money.
Yeah.
Because they tend to correlate. The whole point, my point with the hedge fund, and the first hedge fund, or the internal hedge fund that we started while I was in the bank, was meant to do the opposite. We had a lot of, as a bank, we had a lot of cyclical risk, because if everything is fine in the economy, then the people who borrow money are able to service their interest rate payments, and they are able to service their debt and repay their debt. So banks, obviously lend money, but this particular bank was the first bank in Norway to finance people who wanted to invest in stocks. So again, we've got more cyclical risk in that. So when I took over and I was tasked to run the trading book, I looked at this and I said, there's no point in me adding to our cyclical risk.
Okay.
Because if I do that and we get a downturn in the market, and this is in the mid-90s, if we get a downturn in the market, then we'll lose on everything. And lo and behold, you get the Asian crisis in '97. You get long-term capital management, the world's largest fund, that blows up in '98. You get the dot-com bubble that burst in 2000, 2001. So we got a lot of that, and those years were the best years for the book. I mean, we had the best was the best year. We made 144% on the trading book. While everything else fell apart. Wow. And our worst year, I believe we lost 3%.
I wanted to ask you, How did you navigate to becoming a hedge fund manager? You've also been an investment director.
Yeah, well, I was the CIO for the hedge fund, so I was the chief investment officer. So I kind of decided, the big strategy.
You just run stuff. You ran stuff. You just ran stuff. To say it simply. And you were market maker.
I've been a market maker. The thing is, I started my career as a trader, and as a trader, I was started off in the commodities market, and if the trend is down, you only eat what you kill. I mean, you have to make money in order to get a salary.
Yeah.
No one's paying you for just sitting still.
If you're not creating any
no one's. So there's no sort of a salary there. So if the market, goes into a bear market, you can't be without income for 1 or 2 years. That would, you just can't. No one's going to have you there. So that you're there, and there's a cost of having you there because you've got all the equipment, all the the open lines, the information systems. So you have to make money. So when I entered the market, it wasn't I need a bull market or whatever to make money. I need the stocks to rise. You just had in any situation you had to look for opportunities to make money. So I come from that background. So going from that background into fund management, it was very natural for me to go into a hedge fund management where, you talked about mutual funds just before we started that you guys are setting up a mutual fund. And the luxury of a mutual fund is that, basically the trend is your friend. I mean, if the stock market trend is up, a mutual fund, all things being equal, should make money.
Yeah.
Basically, it's holding stocks, equities, so it should make money.
A strong correlation with this.
Very strong correlation. When the market goes down, well, then the mutual fund does not make money. It can lose money, but no one really expects it to make money in those periods because it's dependent on the moves of the stock market.
Yeah.
So basically, even active managed mutual funds, if you follow the regulation of the Norwegian mutual fund regulation, you don't have a lot of freedom in how active you can be. And most of these so-called active managed funds, they're only active managing maybe 20% of the portfolio, usually less.
Yeah.
Usually less. The rest is pretty much index. So you take 80%, you just go and buy an index, and you can play with the other 20.
But then what value are you creating? I mean, what's the fees? I mean,
that's my point. So when you look at it, so if any fee you pay above, let's say the index, the fee you would pay for an index fund, really has to be looked at as that is only for 20% of the portfolio. So you're actually paying quite a bit. So let's say that you can get an index fund, just to throw out a number, at 50 basis points. You can get them better. But let's say it was 50 basis points.
What does 50 basis points
Well,
mean?
that is a 0.5%, in management fee per
yearly.
year. Okay?
Yeah, okay.
Then you see an active managed fund maybe charging you 2%. Okay? So basically, you are paying 1.5% for them to manage actively 1/5 of the portfolio. So that makes it quite expensive, that management.
Yeah.
While in a hedge fund, everything is actively managed, the entire portfolio.
But there's a difference. You need to be a certain high net worth individual to invest in hedge funds.
That is true. Yes, you need to be a high net worth individual, and I can't remember what there are 3 criteria in Norway to be called a professional investor and to be able to invest in.
You have to have a certain amount of knowledge about investing to take that risk.
Yeah.
You have to have a certain net worth, and I think those are kind of like the main.
But I've seen mutual funds blow up. Because they and no one protects you then.
Yeah.
So, I don't agree with that. What I do think one should do is make managers responsible for, whatever you've said that you are doing, you better do that.
Can I ask you, what was your hedge fund doing? What was your management fee? What were you focusing?
I had 2 hedge funds. The first one was a global macro fund. So we were taking global macro bets, if you like. Okay, so I would trade interest rates, I would trade currencies, I would trade stock indices,
Jesus.
I would trade commodities.
Wow.
Yeah, I would just look for, if I had an idea of, where we were going in the macro picture. Let's say, that I thought that for whatever reason, let's say a war in the Middle East would affect the oil price and take a lot of oil supply out of the market, then I would go and buy oil. I wouldn't go via oil companies unless oil companies were very low valued. And there was a time actually where we did that, and that was and we were very close to the absolute high in oil, which was, I think the high was $147, and we actually and Goldman's came up the very day. Goldman's came out and said their forecast was $208, and I thought, this is going crazy. So we shorted oil, but we bought oil companies against it because oil companies were valuing their assets, their oil reserves, by
way
far
under.
Way under.
Undervalued.
So in this case, it was a better deal to buy the oil companies because of their reserves,
because of the assets, and then short
the oil itself.
That's genius.
So things like that we would do.
You really have to think outside the box doing that, and you really have to take geopolitical situations into consideration.
All the time.
All the time.
All the time.
It's probably pretty underestimated how much geopolitical situation has an impact on these things.
Absolutely, at times. But then, even lately we've had large sort of swings in geopolitical challenges, if you will, trade wars and all that. But a lot of this has been suppressed by the continuous quantitative easing. The central banks buying, printing money, buying bonds, and even buying stocks. The Japanese central bank actually does that.
Can I ask you, how much money under management did you guys have?
We had at the peak we had just over $1 billion.
$1 billion?
Yeah.
That's like 8 miljarder norska, 8 billion Norwegian crowns. That's a lot. What investors did you have? Was it American? Was it pension funds? Institutional? Everything?
We had we had more institutions than we had pension funds. We had Japanese investors.
How do you get them to invest?
Well, that's good question, because and on the Japanese it's quite funny, because another fund management company in Norway called Sector, they also had hedge funds, and they were doing really well, and some investors wanted to come and see them. So coming from Tokyo to the frozen wastelands of Norway is kind of an expensive thing. So they asked, are there any other hedge funds in Norway? And Sector were kind enough to point them in our direction. So we get this call and from a Japanese, and asking if they could visit us. And we were in the office, and about 20 of them show up. 20 Japanese show up, and I'm expecting 1 or 2. So 20, so we had to change rooms.
How many were you guys? Was you going solo?
We was. I brought in a second person, just
when you knew that there was...
because there were 20 people there.
You got to be at least 10% of their amount.
So anyway, so they come in. And I do the presentation of the fund.
In Japanese? No,
no, sadly not.
Yeah.
Anyway, and then I've just done it, and they all get up and huddle in a corner. And speaking Japanese, and I don't speak Japanese, and we're wondering what is going on. What is going on? So they're all in the corner, the far corner, huddling. A lot of stuff is going on. One guy comes over to me, and he bows, and he says, "What is your birth sign?" And I said, "Well, I'm born then." The guy goes back to the huddle, more conversation. Guy comes back and he says, "We invest," and they did.
Really?
That was it. So they were ticking the boxes. And in Japan, when you're born is and I don't know if it's the year of the camel or rat or whatever it was, but it suited them.
What sign are you, by the way?
I'm Leo.
A lion?
Yeah.
Makes sense.
So anyway, so that is probably the most bizarre. But we had U.S. investors, European investors, pension funds.
Just to figure out, do they eventually start contacting you? Probably in the beginning, you get to find investors, you get to find for investors, and then when you prove yourself, maybe they start finding you.
Yeah, but still, it's very competitive. So you're still working. Oh yeah, it is tremendously competitive.
You started the market for aktieoptioner in 1987 through Moorgate, and you introduced options and futures in Norway.
Yeah.
What does options and futures mean? Because like I've been trying to understand these concepts for like years now.
Okay. Well, the future contract is the easiest to explain.
Okay, dumb it down for me.
Yeah, and a futures contract is basically an obligation. The contract is just an obligation to buy the stock, or in this case an index, the OBX index, at a given time in the future. Okay, so you agree the price today, and if it moves up, then you make money. If it goes down, you lose money. But you actually only put up a fraction of the cost. When it matures, you have to, then basically you would have to pay it in full, or you just sell it. Okay. So it moves linearly with the underlying. So when the OBX index ticked up 1 point, the future contract ticked up 1 point, okay? An option is a completely different instrument and a more mathematical beast, if you were. So basically the option gives you the right to buy, or that is called a call option, or the right to sell, which is called a put option, a stock or the index within a given time in the future, okay? So if the index is trading at 100, I could buy an option maybe giving me the right to buy this index at 105, so 5 points above where we are now, and pay a very small amount of money for it, let's say in a month's time. So let's say I paid 1 krona for that, 1 point for that, okay? So my break even then would be 105 plus the krona, 106, okay? Well, if the index in that time went to 110, I would have made 4 times my money. So you get a lot of leverage on it. But the point is, if it fell, if the index fell, I would lose the premium I paid. It's like an insurance. You pay for it, you only use it if you need it, and you don't pay anything else if you don't need it. But if you need it, then then it's worth something to you.
Okay. I wanted also to ask you, is when you're running a fund management, what's considered how big do they get, and how does it work? Is it like, because when you're the fund manager, but you're not alone, you're not doing this alone, you're running it with 100 analysts?
Well, I wish, but no, I actually ran a tight ship. But yes, you do have analysts, and but being the CIO, or then. At the end of the day, the risk was mine. Yeah. I would then decide, do we do this trade? If one of the other guys said, I really believe in this, I would usually give them leeway to do that. Yeah. But at the end of the day, if it's not working and they're not doing anything with it, that I might just cut that position. I might say, no, I like the idea, but we've got too much correlated risk. This just adds to what we've already got, so we won't do it. So you're getting a lot of input, but you have to make the decisions on what to do and what not to do. And the other fund, this was a global macro fund, the other fund that I ran, and I ran that for 4 years, was a short-term trading fund. We only did intraday trading. So at the end of the day, we would be flat. We would have had sold out all our positions and be in cash. Okay, so we had no overnight risk, no risk over the weekend. We had cash. Yeah. But every day, you would have to come in and try to find something to make money on. Yeah. Every day. And that is quite intense.
I can imagine.
Whatever's happened during the night, you haven't made money on it, or you haven't lost money on it, but you're meant to make money. So you sit down and I would trade the 9 largest currency pairs, like euro, dollar yen, cable, and all these others. I would trade the largest index future contracts, the S&P 500 E-mini. I would trade euro stocks. I would trade oil, and sometimes in other commodities, and I would trade the US 10-year Treasury future contract instead of the bond itself. I would trade German interest rates and a bunch of other stuff. Okay.
I just wanted to ask you, for those who watch Billions, it's out now, right? I can bring it that up.
Yeah.
So
the series Billions.
Yeah, the series Billions. For those who are interested in hedge fund managing, that's basically the first hedge fund management series ever created.
Yeah, I think so. Yeah, as a series, for sure.
As a series, and you write you translate it from English to Norwegian.
Yeah, or American, if you will.
Yeah.
Yes, I translate the technical stuff, the finance technical stuff. You know, if they are, you know, if they invest in, let's say, a combination of options, I will write that.
Okay.
If they are doing credit default swaps, which they do, I will explain that. I will write that and hopefully in a way where people, number one is it's accurate.
And
it has to be
sense.
accurate, and hopefully it will make sense to people.
I also just want to ask you, so you have a degree in economics, political science, psychology, and you did 5 years in the British Army.
Yeah.
Out of all of these things, what do you think has contributed most to your personal growth? Because I know you're very, very interested in personal growth from your presentation. And out of these things, practically useful in your career?
I would say that, you know, the army, although it's a few years compared to my age, it probably had the most, you know, effect on me.
Yeah.
Going through adversity, I mean, later in life you will understand that being cold is not even close to how cold you were then. Being hungry, you're never as close to as hungry as I was in the army. Right. Being miserable, I'm never close to being as miserable as I was in the army. And also, I've never been, you know, being afraid. I've never been, you know, no.
So
and
it pushes you to the.
It absolutely pushed me to the limit. You know, you could also argue at times over the limit. But I learned things about myself that I didn't really want to learn, because there's not all good things that come out when you are in very extreme situations.
Absolutely.
But I also learned that, you know, it was a bit, you know, when Darwin says that it's not the strongest and fastest and
the one who can
it's the one adapt, and you know it's perseverance is so important. I mean, it's so miserable. You go through, you know, the first couple of days during a selection, and it's so bad, and you're so tired. Everything is hurting. Absolutely everything. Every muscle in your bone in your body is hurting. You are hungry, you are cold, you are wet, you're usually frightened, you're definitely confused, and you have another 6 months of this, and it's just, and if you make it, then this is going to be your life, you know, and and you want, and you know, the motivation that is needed. And that's why, you know, the strongest and the fastest and all very often don't make it, because they go, sod this for a life. Why would I want to do this? Why would I want to be wet, miserable, hungry, and tired?
And definitely confused.
Why would I want to do that? You know, I can have a nice life. I can go to BI
I can
instead.
go out and be the strongest or the fastest out there.
Yeah, whatever. Yeah. So, but I learned, you know, perseverance, and I think perseverance, you know, later in life, when you become a trader, you will come into periods where you just lose money. Nothing you do is right. I mean, whatever you buy goes down, wherever you short goes up. It just seems like, you know, the gods are against you. And being able to preserve through periods like that.
Periods of adversity, that's important.
Adversity, and you will have those. As a trader, you will have periods of adversity.
I'm not going to say that I have a lot of years behind my back, but I think as early on in life, you want to go through large amounts of adversity in order to just thicken your skin. Because then everything else becomes not necessarily easier, but it normalizes your ability to interact with adversity and deal with it and come through it. What about political science, psychology, and economics? Shortly.
Economics has had the least impact, to be honest. It has.
That's what I'm studying.
I'm sorry about that. But you know, the law of supply and demand and the law of diminishing returns; those two things make sense. The rest really didn't matter, or hasn't mattered. In you know, it's good. You know, but education is always good. Put it that way. I would say psychology has been very, very helpful. Really? Because knowing psychology, knowing how your brain works and how your emotions work and things like that really can help you. Just knowing what breathing, rhythmic breathing will do in terms of quieting down anxiety and fear and things like that. I was I've done everything wrong. And when I went into the army, I didn't know that I had a fear of heights. And the unit that I was in, definitely, a big part of that was jumping out of planes. So I had to, on so many levels, figure it out, in order to at least appear calm. Total turmoil inside, but you're sitting there and even smiling. You just hate it when people crack jokes in the plane.
I can imagine. That's absolutely right. Through psychology, you learn about yourself, but also about others. So
yes.
That's really interesting. Just to start wrapping it up a little bit, so I want to ask you, for students who want to become a hedge fund manager, equity manager, what would you suggest the best way to prepare yourself?
Well, you definitely have to have a masochistic streak, because you're going to have a lot of pain. You're going to endure a lot of pain. And in this country, it's actually difficult because of regulations and a lot of things are against you when you do it. I mean, becoming a mutual fund manager is by far the easier life.
Okay.
I would argue that the hedge fund manager has a more interesting life, for sure. So if you're into interesting life and style, then that could be. But what would I do today? Because things have changed massively during the years. Technology is extremely important. You can't avoid quantitative finance. And understanding technology, being able to code, just understanding coding, what you can do with these tools, you need to know that. The market out there has changed abruptly and massively, and it's changing every day, and it's going towards, as everything is big data, AI, everything is going faster. You need to understand that. You really need to get a grip.